Good afternoon, everybody. My name is Jeffrey Halley and I'm a Senior Markets Analyst here at OANDA Asia Pacific here in Singapore. And today we are going to go through what will be a regular weekly update of the commodity and precious metal setups, looking at the different contracts on the OANDA platform, and maybe just discussing about what's actually moving these and what's been happening with them. And today, before I start on precious metals, I'd actually like to bring up another word, which is rates. And by this I don't mean FX rates, I mean interest rates. Some very interesting price action has been occurring on interest rates over the last couple of weeks while I've been away on holiday, in fact. And as we can see from this US 10-year chart here, rates have been moving up, i.e. the price has been coming down, and interest rates have been moving higher, so yields have been moving higher. And we're not just seeing that in the US 10 years, we're seeing that in the US 30 years as well. And we can see here that the 100 and the 200-day moving averages, in fact, have been broken. The blue line being the 200 and the red line the 100-day moving average. If we go over to something like bunds, we can see the same pattern repeated. So let's just pop over there and have a look at the German bunds. Here we go. We can see here again some hawkish rhetoric, potential tapering from the ECB, and we've seen rates again plummeting. Well, the prices plummeting of the bond contract, yields moving higher. And we can see here that we've dropped from 164 all the way down to 159.2 before a slight relief rally. But in the meantime, we've seen the 100 and 200-day moving averages break yet again on those contracts. If we go over to gilts in the UK, now the UK has had quite a dovish Bank of England, but surprisingly, that's not being reflected in the long end of the yield curve. And yet again, we can see here the yields moving higher in gilts, and the price of the gilt contracts moving down. And again, yet again, the 100 and the 200-day moving averages have been broken. This could actually be quite significant, I think. We have a Bank of Canada a meeting tonight. There's widely expected to be a rate hike there. But generally, around the world, with the exception really of Japan, the longer term rates in the yield curves are starting to move ever so slightly higher. And this could actually have quite significant implications for commodities, but also in particular the prices of gold and silver, and to a lesser extent platinum. The inclination of investors to hold precious metals will diminish the higher that interest rates around the world go, simply because in the absence of any safe haven buying, precious metals don't pay a yield, and if yields move higher on the bond markets around the world, then this makes those commodities much more, those contracts much more attractive as investments as opposed to precious metals. But that could be a story for another day, but certainly worth those of you viewing this to keep this one in your back pocket, because it'll be interesting to see whether we are actually now starting to finally see a bottom in global rates. Let's crack on with it now. Let's start off with gold. While I've been away on holiday, actually gold has been on a one-way rip all the way down to 1,204 before it's made quite a good comeback, really, up to the 1220 mark. The chart does look a bit busy, I will admit, and the reason I've done this is because of a Fibonacci retracement that I've put up actually on the chart. So don't be too terrified straight away. This may make it look a bit better. We can see actually the RSI is actually not oversold at all, which gives us the impression that we can probably see more downside to the gold setup without it becoming an oversold market, should that happen. But anyway, look, the Fibonacci retrace I've taken from the lows in December, which were around 1123, all the way up to this huge double top here that we saw in the course of this year, which topped out around 1296. So, and you can see also on the right hand side where I'm waving my cursor now, it failed just ahead of that 1296 level. This is a huge level for gold in the longer term, but we can see here that the retrace, the 50% retrace down to 1209.35, this is where gold appears to have found some initial support. We note here with the bars that there's been no daily close below that below that 50% retracement. In fact, it's been down and tested it a few times, had a look through it, and then popped back up again. This may mean that we see gold itself find some short-term support around this level, and we really need to crack on through this and have a daily close below it before we start getting too bearish again on gold in the short term. Although, as I said earlier, if US rates, German rates, developed market rates continue to rise, that may see the bears coming out again. In the shorter term, we have technical resistance around 1,230, and then we have this blue line here, the 200-day moving average, coming in at just around 1231.4. So this 1231.4 is the immediate resistance inside the in the gold setup. And we notice actually when gold does tend to break this blue line, this 200-day moving average, it does tend to move and have a continuation sequence afterwards. We can see here back in looks like early May where we broke, we moved higher, and we can see when it moved down through this in early April that we actually had a continuation sequence. So it'll be interesting to see whether we actually have a continuation sequence here, or we've actually seen the worst of it now. Let's head over to silver. Again, much like gold, it's let's just squash this chart up. Been following gold to the downside. Silver does tend to lead gold, and the reason for that is because there's generally less liquidity in the trading pot with silver, particularly outside of North American hours. So the moves tend to be more extreme. If we move over to the right hand side of the chart, we can actually see this from last Friday, which was the non-farm payrolls. US rates moved higher, and I think actually what we've seen here is basically panic liquidation. Looking at this bar, once we broke this 1595, 1590 area, and that suggests this bar here that we saw panic selling, stop liquidation as we broke these longer term levels into a liquid market, and you can see that we have actually traded down to 1492-ish, and that will be the first line of major longer term, medium term support on this contract. Since then we have actually seen it's had 3 successive up days, much like gold has, but we can actually see around the 1620 at 1624 really. We've failed a few times up here, and this will be the first resistance level for silver on the way back up. Clearly above here, way back above 17.20, we can see the 100 and the 200-day moving averages sitting around 1722, 1725, and this would be some quite formidable technical resistance should silver manage to come up for air and get back to those levels. Moving over to platinum, come to me. Again, don't be frightened by this chart. Let me just squash it up for you to show you more of a concise picture here. Platinum is standing out to me because it is actually sort of bouncing on the bottom of some quite significant long-term support around this 888 level. But when you put when I was looking at it, what I saw was potentially a head and shoulders pattern. And we can see on the left hand side one shoulder, the head is this peak up around nearly 1200, right hand shoulder is here around that was from the from early March, the highs here. I might be clutching at straws here slightly, but I do feel that if we do see a break of 888, this could signal a technical move. You can see here as I'm circling this at the bottom of this down arrow, this 306, that's $306. So theoretically, should this actually be a head and shoulders pattern, there is potential for a technical move with a target around sort of like the $600 mark. And we can see again that platinum is not oversold. I would actually say that it does, from a technical point of view, look a little bit more bearish in the longer term here now than, say, gold at the moment. But this 888 level is definitely the level to be watching over the next coming week. If we move over to palladium though, the story changes again. Now we all have to remember that palladium, in addition to being sort of a precious metal, also has a massive industrial usage. And this changes the dynamics of this metal completely from platinum, silver and gold. And as we can see here, longer term, platinum has been on a mighty bull run over the last year or so, more than doubling in price. So yes, it has had a correction, a slight correction, but really when you look at the scale of it, it's nothing like the corrections that silver and gold have had proportionally, or even platinum. And we can actually see too that this long-term support line, this blue diagonal line here, is still quite intact and really under no serious threat whatsoever. And I, just for readers' information, the actual long-term support comes in around the 786 mark. You'll just have to take my word for that one. Before that, we have the 100-day moving average, and that's sitting around 810. And then up here, we have just below the Friday low, we have support at around 828. But readers and listeners, you must keep in mind that palladium does have dual uses, and thus its trading dynamics are quite different from the other precious metals group. Mostly palladium is actually used in catalytic converters in cars. In fact, this metal I probably get asked about more than any other metal, simply because its dynamics are at times quite strange. If we go over now to copper. So copper again, I've done another Fibonacci retrace here, and I think what's interesting about this is that this huge rally we've had here from what that was early last year, January, February, from 193.35 all the way up above 2.80. At the moment, we seem to be finding some support at this 38.2% retracement level, which is around 247.86. Now I can see that it has actually broken through that level a few times here, most particularly in April. But what readers should actually take note of is that it has not closed below that level. So the little bars on the right hand side, the notches on the right hand side of the bar, none of them are below this support line, which actually validates the fact that this is actually important technical support. So for those of you who are following copper at the moment, 247.86 is your key support level. But before that, we do have the 100-day moving average at 259.97. We'll call that 2.60. And then the 200-day moving average around 254.15. So actually support-wise now that copper has managed to actually break back above this red line is reasonably strong from a technical point of view. And so copper will have some wood to chop, so to speak, in order to break lower from a technical perspective anyway. Interim resistance is sitting around these three previous tops around the 2.70, and then of course way up here at 281.60, that represents the sort of medium term resistance, was the previous high way back in February. Copper itself is very closely correlated to China, most particularly to the China housing market for obvious reasons. They use a lot of copper in them, and also for fixed investments as well. And also, it's also worth watching the dollar CNH, the dollar CNY rates as well, because the weaker that CNY tends to get, that tends to make copper more expensive in RMB terms and Chinese yuan terms. It costs more of these Chinese yuan to buy a kilo of copper. So demand does tend to fall slightly when the RMB and the CNH weakens. So listeners may wish to keep an eye on those two currencies for traces there. If we see some strengthening in those, it could actually lead to strong demand in copper, and if vice versa, if it weakens, then we may see demand petering out for copper. So yes, we do have the charts, but it's also worth looking at the bigger picture. Let's leave the metal side of things for now and head over to the energy side, which again, while I've been on holiday, has been somewhat emotional. I will fully acknowledge that. Before I went on holiday 2 weeks ago, we were sitting somewhere around the 44 mark. Since then, Brent, let's blow this up and bring it out so we can see some of the action more closely. Brent rallied 12% and then fell 8%. So if you're looking for a bit of volatility in your trading portfolios, you certainly won't go wrong trading oil. And intraday vol tends to run at least 1 or 2% each day anyway. The world seems to be at a bit of a crossroads here with oil. If I'm looking at Brent crude right now from a technical perspective, quite clearly the range, the medium-term range, as far as the charts go, looks like it's around 46, which is this red line down the bottom here, up to about sort of 49.7, let's call it $50 a barrel. So 46 to 50, it looks like the range for now, and I think everything in between these two lines is noise until such a time that we get a daily close above or below. Longer term, of course, this low down here at nearly at around 44.25 will be key support. And of course, on the top side here, you can see a series of highs. If we look around the 55 level, and of course around this 56.5, where we can see 56.5, 57, where we can see multiple failures before the price crash. OPEC is meeting for a committee meeting, shall we say, on the 24th of July. There may be some noise out of that. There has been some rumours that they may increase the production cut. I personally think this is extremely unlikely because they just won't be able to get all their barrels lined up in a row, so to speak, to get everybody on board for that one in time. And it would be a huge surprise to the markets. Having said that, yesterday we had the API crude inventories. The American Petroleum Institute had a massive 8.8 million barrel drawdown. That was expected to be sort of something like minus 2.2 million. So the crude inventories, the official Department of Energy ones, this evening, Wednesday, if you're watching the video this afternoon, will be absolutely crucial for the short-term price action of oil going forward. And if there's a big drop to the downside, i.e. a much bigger than expected drawdown again, this may actually support prices in the short term at least until we get to that OPEC meeting. It has been a pretty brutal trading session. If I was to look at this chart, I would say that there was, as we were into early June, a lot of stop loss liquidation of long positionings post the OPEC rollover of its production cut deal. And then a reaction low there where we're mass liquidation. Then the market has basically got long again as it's rallied up to about 50, and then there's been an aggressive mass liquidation again down to this 46 level, which has the look of what we call in the markets a whipsaw price action. If we move over to West Texas Intermediates. Right now, much the same as Brent, but it trades at a discount to Brent crude. We can see here, let's just move this little support line on the bottom up a little bit. There we go, much better. Okay, long-term support is this reaction stop loss driven low in Asia from, I think that was mid-June or late June. Around the 41.80, call it $42 mark, and we've seen a reaction high up here around the 47.25 level. And I think that is actually the defined range for WTI for the meantime. That still gives traders plenty of opportunities. If you're looking to range trade, for instance, you may be looking to perhaps sell rallies up towards 46.5, 47, and conversely look to buy dips around maybe the initial support here at sort of 43.5, and then this sort of 42 region. So there are opportunities even in a ranging market, but frankly, I mean, this is a 10% range, probably a bit more, and we've had like an 8% pullback. So, you know, there's still plenty of vol to be had within this. Again, like Brent, it's in a bit of a crossroads, and we could end up going either way. Having said that, behind this resistance level around 47, we do have the 100-day moving average around 48.5, and the 200-day moving average around 49.4, and both of those will be quite formidable resistances. If you look at actually the charts here, we can see that the WTI contract has been nowhere near the 100-day moving average, this red line, for well, quite some time. So I would say that from a technical perspective, a daily close above those levels could represent perhaps a pivot in the longer term price action, just from a technical perspective anyway. Let's go to corn. We're into the softs now, so the end is in sight. What a rally this has been in corn, yeah? So sometimes these soft commodities get left behind in traders' perspective, but from a portfolio diversification perspective, I think it's always interesting to have a little bit of commodities in your trading portfolio. They tend to be more longer term trades. Now, it doesn't look actually that exciting here as we look at the longer term chart, but actually when we blow this thing up and we look at the price action for the last 7 or 8 days, we can see we've had a massive rally from around sort of 3.5 all the way up to 4. So you know, we're talking there maybe, well, top of my head, something like a 15% rally. So that's pretty impressive, yeah? Now, what's driving this price action? There is plenty of corn around in the world, that's for sure. But actually, the answer is in fact wheat. And although there is a lot of wheat actually in the short-term market, a lot of really important areas of wheat production, such as the American Midwest, Australia, Spain, Eastern Europe, are all suffering from suboptimal growing conditions, and also they're also suffering from droughts as well, particularly in Australia, and Spain is actually having to import wheat from around the world this year for the first time in memory. So although there is a lot of wheat at the front end, traders are starting to price in shortages going forward. This brings substitutes into the market. So as wheat has actually increased massively in price over the last few weeks, traders are looking for things that can be used to substitute that, and corn is one of these commodities. This, of course, has had the effect of driving up the prices of corn as more demand comes in to substitute for whatever they're using their wheat for. Also, I do believe that there are large amounts of hedge fund short positions had been put on in the corn market and in the wheat market as well, and this price action, as we see this ascending price action on the right hand side of the chart, is perhaps representative of also some pretty serious short squeezing of those positions and probably short liquidations. I think what the important thing to take out of this is that we've broken the 100-day moving average, this red line here, and actually if you look back here, with a few exceptions, actually the 100-day moving average over the last, over this year in particular, has held pretty well with corn, yeah? Bear in mind that as a portfolio, it's not going to be a huge amount of your portfolio, so maybe you might have a few small positions in it, but it's actually, it's held remarkably well. And if you look at the 200-day moving average, we can see that every time basically in the last year, since corn, when corn hits towards that 200-day moving average, it actually hasn't managed to break it. So we can see over here on the left-hand side, and then we can see over here on the right-hand side, every time it's been down, it's actually had a pretty good rally afterwards. So I guess apart from looking at technicals on these commodities, you've actually got to be doing a bit of reading and having a look around at what's going on in the world, and look at what can be actually substituted. Let's go to my last commodity of the day, which is sugar. This is one of my favourite charts at the moment. As a technical trader, we always love it when our technical patterns work out really well, and we love to shout from the balconies about them. So this is one that I will as well. It does look quite complicated. Let me just take you through this. From the top, we have a giant head and shoulders pattern on sugar, and we have for a while. Yeah, we've had huge harvests in the major producing areas, and that's put downward pressure on sugar prices. But if we look here on the left hand side, we can see the initial shoulder, then we can see the head in the middle here, which is around 23.55, and then the second shoulder here with the 100-day moving average crossing over the 200-day moving average. And what's interesting here is you always, the way you target these head and shoulders is that you measure from the neckline up to the top of the head, and in this case it was around 5942, so 59.42 ticks, however you want to call it. So that means that the price target is 59.42 below this neckline that I've drawn in, and this price target gave us a number of around I think it was 0.11925, so let's call it 0.12000 for ease of use. These things are never particularly, with technicals, you never get everything precisely to the tick. So actually, this has actually been down and gone pretty close towards that overall target around 0.12. It got down to like 0.12510. And this all leads me back to my previous point that, sometimes it's not a bad idea to look at the soft commodities and the commodities in general, and maybe just think about having some of these in your portfolios, because they tend to be longer term trades, and actually they tend to be quite good trades. So I mean, in this case, if you just blindly followed this head and shoulders pattern and you'd sold here, you'd have actually over the last few months actually made a pretty good return on that trade. If we're looking at what could happen now, we do seem to be struggling on the retracement. This high here around 0.14180 is the first resistance, followed by 0.1450, and it needs to break this level now in order to really be considered that it will actually have an attack on this 100-day moving average, which is sitting at 0.16. What could happen is that it could move back down again to the support level at 0.12510, and then it could actually also push on and actually try and make progress towards this target, this overall target of 0.12000. It could go either way. We may just sit here consolidating in this bearish down pattern for a little while, or we may well have actually seen the bottom of it yet. Probably a little too soon to try and tell. I mean, but one thing is for sure, I mean, this has been in a steady downward trend from top left to bottom right since late February, early March, and we really haven't seen any sign yet of a meaningful technical move back up or a bottoming formation. Also note that the RSI is actually solidly in neutral territory, so actually it could move either way. So it still is a very interesting formation, and it'll be interesting to see how this actually develops over the next couple of weeks. Well, that brings me to the end of the precious metals and commodities weekly roundup. I hope you've found some of this informative. I hope that you've understood my Kiwi accent. I wish you all the best in your trading for this week, and have a great week ahead. Thank you very much.